G'day folks, welcome back to another update, and today we're looking at NVIDIA. Now the charts are showing record highs. We're going to include some back testing, so don't forget to hit that like and subscribe button to support the channel. Before we proceed, if you haven't already, I strongly encourage you to invest 24 minutes of your time and watch the +1 video entitled Follow the Trend with Average Down. This, I believe, clearly illustrates how to trade with almost any indicator profitably. I use this approach in all my analysis when reviewing instruments, including today's review. Links in the description below. So as of today, July 10th, record revenue, second quarter of this year, revenue reached $30 billion, up 15% quarter over quarter and 122% year over year, surpassing analyst expectations. Data center dominance, data center revenue soared to $26.3 billion, 154% increase from the previous year, accounting for 88% of total sales. Profitability, net income rose to $16.6 billion, up 168% year over year, with a gross margin of 75.1%, reflecting strong demand for AI infrastructure. Earnings are forecast to grow 20.48% per year. Earnings grew by 80% over the past year. Shareholder returns, NVIDIA authorized an additional $50 billion in share buybacks, indicating confidence in sustained growth. Market leadership, the company's market capitalization approached $4 trillion, underscoring its pivotal role in the AI-driven tech boom. And in terms of risks, significant insider selling over the past 3 months. So again, we always look at the long-term trends, and then here we've got the monthly, the weekly and the daily, and on the monthly, we've got these moving averages where the price is still well above the moving averages, giving us a bullish momentum. Although notice here on the CCI 150, the CCI broke into that moving average range, resulting in those dips. Now in this one back here, we had a bearish divergence, and that CCI is still actually declining, so just be cautious of that. We had again a bearish divergence there with the prices going higher and the CCI dropping lower. And in fact, it came down and hit our target range. And that target range, if I zoom in for a moment, that target range there, the blue area, that was a 23-38% range of the Fibonacci level for those new to the channel. We take it back to that low there before that divergence started. Remember, this is a monthly chart, so it's a very long-term play. Started back in late 2020, well, actually started in 2024, but the Fibonacci goes back to 2023. And it hits that 23-38% is a minimum range. In this case, it came down and bounced off that 61% Fibonacci level. So that divergence seems to have been played out. But notice we still have a bearish divergence, draw a new divergence there between that peak on the CCI to that high there. That's a declining CCI versus the same period on the price chart. Higher highs versus lower highs on the CCI. So again, just be cautious of that. Also, before we leave the monthly chart, notice here we've got, let me just get rid of that Fibonacci for a moment. We've got these blue or light blue areas colored. And what I've done here in this red area, I've highlighted that period between those little blue areas. And they're basically fair value gaps, and that's basically unfilled orders. This one here has been filled with the wick of that candle, and subsequently these other candles back here with the wick of that candle. Notice here we've got another fair value gap, and I'll mark that as well. And that means at some point we're going to see the price very likely break down to that level there. That also coincides with this bearish divergence. So just be cautious about going long too heavily. The monthly is showing a long-term bearish divergence, as well as this large area of fair value gaps that haven't been filled yet. This one back here was filled about 50% of the range. I haven't marked that, but that's also a caution to be aware of. So long term, it could actually decline, but again, we take it one step at a time. And I'm not suggesting you close out your trades now. We close it out in the direction of the time frame you're trading. Now on the weekly, we've also had another bearish divergence. The CCI dropping and still kept dropping. You can see there it hit our minimum 23-38% range and kept dropping further. And again, if I was to draw a Fibonacci between that high of that weekly range, that would have been down to that range there. That was the initial range. We'll take it back to the previous low before that divergence started. That's at 23-38%. You can see there it broke below the 61% level. So I like to take the divergence range or the Fibonacci range of that divergence to the significant low before that divergence started. Now at the moment, the price and the CCI are still above the moving averages, giving us a bullish momentum. Although notice here on the weekly as well, we've got a fair value gap that hasn't been penetrated yet. So that may also coincide with the monthly decline potentially. Again, that's a longer term play. On the daily, it's actually broken through this previous resistance we drew at 153.70, and again, there's no sign of a pullback yet. The CCI and the price are well above the moving averages, and again, that little fair value gap is 50% filled. This one back here is 50% filled, and there's no other sign there. So, and there's no divergence to look at or to be aware of at this point. Those highs on the CCI are higher than those previous highs, so there's no divergence. So the daily's looking okay for the moment. Now, if we go to the intraday chart, we look at the 1 hour chart as well. If you're trading on the daily, we also look at the 1 hour to see if there's any micro moves. You can see here, back here, we had a bearish divergence. Actually had a couple of them. The first one there, to those higher peaks there initially, it dropped off slightly, and then we had a second level divergence there, and that also dropped off very slightly. It didn't actually hit our minimum target range. Sometimes these fail. If I drew out, it depends where you draw the low. So taking it back to that significant low there before that divergence started, you can see there it hit the 23.38% with that little range. And then if you extended that to that other high, that also just touched that 23 or broke into that 23.38% range, and it bounced out of there. And that's all it needs to do. All it needs to do is touch it and bounce out of it. Sometimes it breaks a lot stronger to the downside, and a lot of other times it just touches it and then bounces out of it, and that's what it did in this case. But again, if you're trading on the hourly, I'll show you the back test in a minute. You just keep following the trends on the daily, but also the hourly. And at the moment, what I'm looking for is a divergence. You can see here, we've got a bearish divergence, lower highs on the CCI in the same period, higher highs on the price. And that, so again, if I was to draw a Fibonacci, I'd take it back to that level, to there. We can expect a minimum retrace level to that area down here, the 23.38% range. Now that's assuming it does pull back from where it is at the moment. Of course, it can keep going higher, and as long as the CCI keeps dropping and the price keeps rising, we're just going to extend that range and readjust that Fibonacci target range, which means it'll probably just rise very slightly, again, depending on where it starts turning back. The confirmation of that turn back will happen when it starts breaking below that moving average range, like it did back here. So if that starts breaking into that range and below it there, then you're going to see it's almost going to touch that immediately once it does that anyway. Again, there's no divergence on the daily, but there's a bearish divergence on the hourly. Now, in terms of the back testing, if you're trading on the 1 hour time period, what I've done here on the daily, starting from the 24th of April, when the price and the CCI broke above the moving averages, up here I've got the stop loss profitability, and this one's the average down profitability. So two different strategies and both are taking a 3% gain, or a 0.3% gain whenever they breaks above the 3%, and this one takes a 0.5% stop loss, and this one averages down whenever it drops by more than 0.5%. So they're using the same percentage parameters, except this one averages down, this one takes a stop. The stop loss approach is down about $250 odd. The average down approach is up about 3,900. Now, the first rule, if you follow my other video, follow the trend rule, the 3 rules. The first rule is you're making sure you trade in the direction of the larger time frames. If you're trading on the hour, you make sure you're trading in the direction of the daily. And the second rule is close out the trade at the very earliest or the latest when the CCI breaks into that moving average range. So you can see there you would have closed it out at that point there. That's the equivalent on the 1 hour time period. And the third rule is at the very early, or the earliest point you should have closed it out was when you see a bearish divergence. And that first bearish divergence at that point there, you would have closed it out somewhere there, and that would have been near the high of that little range there if you're trading this period, which means you would have got out with a small loss on the stop loss approach, but you would have got out with roughly about, on the average down approach, about $2,000. Again, as soon as that divergence is played out, there was another bearish divergence there that dropped off very slightly. As soon as you start seeing the CCI and the price break above the moving averages, you would have taken long entries again at that point, and again let it go. And at this point here, once you start seeing the CCI dropping off, and if you zoom in there, that little range there was the first sign of a bearish divergence, and you would have taken your profits near the highs there, especially when it starts breaking below that moving average range. So you would have probably taken your profits at that hour there on that point there. So as I said, where we are at the moment, the CCI even is still declining, even though the price is rising. Probably start taking other trades if that breaks higher, And so long as the daily is in an uptrend on the CCI and the price, and the hourly also starts trending up in line with the price, then you can probably take some long trades. But again, be very cautious. That CCI is still in a decline, and as I said, it may come down to this area initially. So just be aware of that. If that theoretically breaks into that range and bounces out of there, then we can start probably taking more long trades from that point. So if you're new to trading, we're now including a weekly video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on the free trial to my Patreon page, where I publish weekly bullish shares across regions of the world's markets. Thanks, and talk to you in our next video.